Alexis, let's just talk about what you've seen so far with the IPO market. How has that trickled down into the Valley? And is that changing the way venture capital firms start looking at new funding that they're putting to work today?
You know, what is clear is this IPO roadshow trend is falling out of style. I think one of the things that has been most apparent to most CEOs of late in tech is that for all of the virtues and the excitement of becoming a publicly traded company, the way that the public markets work in terms of incentivizing CEOs to focus on short-term as opposed to long-term has been a challenge. And I think we're seeing more and more alternatives be devised and crafted. We were early investors in long-term stock exchange, which wants to be a way for CEOs to get their companies some liquidity, but to do so in a way that's responsible for long-term investment.
Alexis, it's so interesting to hear you say that, because I was talking to a guest last week who said, the mood in Silicon Valley right now is to try and stick it to the bankers, that they're sick of kind of getting held up by what's happening with the IPO, and if they can, hose the bankers for another 5 cents, they're going to do it. But then if you look at something like the direct listing that Slack just listed, that didn't perform so well either. So what's the answer?
I think a different model for even how these exchanges can work is really in order. One that incentivizes people who have had positions in the companies for longer terms to have a bigger vote, but also one that really takes into consideration the fact that stock prices change every second, and yet the actual value of companies don't change nearly that often. So how do we really think about even the fundamentals of how these marketplaces work that allow for liquidity to happen, but at the same time take into account the fact that we want companies to be focused on long-term growth as opposed to quick sort of impulse decisions? I
think that's part of the problem, but let's also just confront what the private market valuations have gotten kind of out of control. When you start looking at a lot of them involved with SoftBank, where they were looking for the long haul, we're building growth at any cost. Okay, try selling that to the public that you're now going to continue to lose money for an indefinite amount of time and expect that you're going to get nosebleed valuations. Is that just over?
Yeah, I think in a lot of ways, later stage private investors have been valuing companies a lot differently than the public markets, which are much more ruthless. And I think it's going to sound very obvious, but gross margins really do matter here. And there is truth to the fact that every business needs to be a software business now. I really do believe that. The difference, however, though, is the private markets have been valuing a lot of companies that are a lot less software than they are other things, and the margins reflect that. They don't have traditional software-type margins, whereas the companies that have IPO'd this year, that do, Zoom being probably one of the most prominent ones, have actually performed well, and I think that's a reflection of the fact that they are much more true to those sort of gross margin ideals of software. And it's those later stage private markups that have gotten hit as they've met with the reality of the public markets.
That's actually a great point. Just building on that, how would you value a company? And I'm just using these as examples because they're out there right now. WeWork being a commercial real estate company versus being a tech company, and so many of the other ones that are out there. How do you find a fair valuation for these companies that are saying they're technology companies when in reality they're using technology just like every other company is right now?
Yeah, and look, there is a difference between companies that are sort of not traditionally software companies, but that have the product teams and the software teams internally that are able to build it. But at the end of the day, I think commercial real estate is a great example of a space where companies should be judged on their ability to generate cash flow. It is a really straightforward metric. It's one that's been used for a very long time for these types of companies, and it's a great way to show that they're onto something, that they are building something that's sustainable, and that just doesn't look like 10x on revenue, which is how software companies tend to be valued.
Alexis, whatever the precise numbers are on WeWork's most recent private round and its value today, have you, as an investor, ever gone into something and seen within a year, 18 months, its value be some 25% of what you had invested in? And if so, would you expect to get a pass and still have your credibility going forward? Or how many passes do you think investors in early stage companies should get for those types of errors?
Yeah, well, so we're fortunate at Initialized, we do such early stage investing. We're often the first check that we do see these down rounds from time to time, but they're not that significant because the amount of money that's been invested, the size of the business is still very, very small relative to what we're talking about here. I think there is a real question now. It has been something we've talked about on air before, that these private investors have been able to enjoy up rounds as companies have held off going public that normally retail investors would be able to get. We're seeing that now really get dialed back, and I think there's going to have to be a lot more sobriety when these later stage firms are doing these valuations, because the markets in many ways have spoken on how these companies should be valued. I do at the end of the day think there is a truth here, which is every business doesn't need to be a software business, but every business should not necessarily be valued at software type levels.
Is the takeaway, though, from that, Alexis, that ultimately with the volume of money still in venture capital hands looking for these big opportunities, and if you don't have that ultimate exit from the public market that's willing to kind of bless those aggressive valuations, is there just not too much money chasing a more finite group of great opportunities than we thought before?
I still believe in the value of the entrepreneur. I still believe in innovation. I still think a few of these companies that have had disappointing IPOs are going to actually in the long term be very, very viable businesses. And so I still really believe that there is a lot more innovation to come. And while, yes, the later stage is awash in capital right now, there are many more great companies being founded and being invested in, and that are going to make good use of that money.
One more quick question, Alexis. When you look at all of the noise in Washington and in other places where regulators are kind of checking out what's happening with big tech, is that something that's flowing down to the VC level? Is it changing the way people invest right now in Silicon Valley?
We love investing in David against Goliath, and if these wins are any indication, those Goliaths are going to have a lot more scrutiny and actually probably see some form of regulation or another. And so that just means more opportunity for the Davids, more opportunities for the upstarts to start to challenge them. And so if anything, I suppose it gets us a little bit more excited on the early side of things because we see more opportunities for companies to come in and drink their milkshake. But at the end of the day, we don't do our jobs because we want help from Washington to regulate or enforce. We do our jobs because we believe in these entrepreneurs providing real challenges and real improvement.